to share your thoughts on the business. So, Imran, this week we're going to be discussing a not so well-known British company called DS Smith. Why don't we start by telling us what this company does?
I think you've been a bit kind there by saying it's not so well known. It's probably rather boring, probably rather unsexy sort of business that we're looking at today, or we're discussing today, which is DS Smith, which is essentially a packaged sustainables company. So it's a sustainable packaging company. So you can imagine one of their key products is cardboard. So cardboard is obviously used in all sorts of industries, and for DS Smith, the business which started 80 years ago, starting in cardboards, with one family in particular, the Smith family, they expanded those sort of cardboards into paper making and then into recyclables. And they focus on three main areas. So they look at manufacturing packaging. So if you're the likes of a Nestle, or you're the likes of Cadbury, or any of the fast-moving consumer goods companies, you're going to have your products put into these cardboards. Not only that, is if you're into logistics or you're moving these from your production facilities where you're producing these goods and items, you're going to then put them into trucks, and again, you're going to have congregated cardboards boxes, which essentially have those ridges, if you've seen them before, which allows for basically the cardboard to be stronger and more rigid. So that's sort of another area. And then the third area is marketing. So all the sort of outdoor marketing that you see, which has the sort of paper marketing campaigns that you see, so not the digital ones, but the ones that are done by paper. DS Smith is one of those who are sort of producing the actual material for that, and actually the artwork is being printed on those. So they also obviously do the artwork that's given to DS Smith, they put onto their boxes, but it's all done in-house. And actually it's become recyclable. So at the moment, 80% of their materials are recyclable. So they basically have this circular business model where they take excess sort of used cardboards or paper and they can put it back into their process to produce cardboards again.
That certainly sounds like a useful advantage to have, especially today where a lot of people are getting more aware of the effects of the environment. Having this ESG aspect certainly helps differentiate them a bit. Now, we don't really think about it, but obviously cardboard is very important to everyday life, especially with e-commerce now ticking up. Thank the pandemic for that. Even with brick and mortar retail, I think that the e-commerce sales as a proportion of total consumer spending is now higher than what it was before the pandemic. But yeah, if we get back on topic quickly, because we're tangenting a bit, the company obviously was founded in the UK, and with such a vast market, it started to expand internationally as well. Could you give a breakdown of what the revenue now looks like?
Yeah, sure. So as I mentioned earlier, the business started 80 years ago, and today it still has 15% of its revenue within the UK and 15% in France and Iberia, and then it's growing a position in the US at around 9%, and sort of Italy and Germany again at sort of 10%. So it's fairly well distributed, the revenue streams. You could say, well, 15% isn't 15 and 10 isn't a huge difference. So you can say it's a fairly broad revenue stream, but predominantly in Europe, Northern Europe and Southern Europe is where they generate most of their revenue. Unfortunately, as I mentioned earlier, the different sort of divisions, you can sort of say this business just produces boxes or car boxes across these different areas, and the group doesn't tend to give you a breakdown of anything more than that. It just tells you that these are the revenue streams in these different areas, and then the costs associated with those revenues.
So what sort of costs would this company have to deal with? I imagine raw materials is probably a large chunk of that.
I'll just share, what I'll do is I'll just share the premium note, which people can find access to in the link below. This is just our premium notes, just a quick rundown. What we do in our premium notes is we give a breakdown of the company, of what the business does, historical performance, revenue cost drivers, fundamentals, which we'll talk about a bit later, management, and a very nice competitive advantages icons, which we've added recently, and also just the competitors, which people might find useful as part of, if they're doing any research, and then risk profiling, and then valuations. And our COG score, which I'm not going to share here, you can look at the premium note yourself to look at the COG score, which will give you an idea of what the business is what we think of the business So if we just quickly go back to the costs, you have cost of sales, which, as you can expect in this sort of business, this business is very labor intensive. So
Mm.
it hires 30,000 people across all those countries in Europe, which is
Oh,
quite a large number of people. And when you think about it, when you look at tech companies and other sort of companies that we've looked at in the past and the amount of employees they have, this one is very sort of labor intensive, as obviously you need people to manage this process. And that's really what explains that 47% cost of sales being so high. In addition to the materials, it's a physical, serving a brick and mortar customer. And it is a physical company in its nature by the fact that actually majority of its, well, we can talk about the assets later, but the majority of it, all its goods are tangible versus intangible. So they're not selling
yeah,
services online, or they're not selling any digital products. So hence why you've got such high COGS. And the other areas are just other production costs, distribution, and then administrative. But yeah, the large chunk of it is COGS, which, given the current environment where you have inflationary pressures, you
yeah.
can say that there is potential pressures for margins in the future. Margins, contraction of margins.
I think that's definitely something to be aware of moving forward, especially with all sort of manufacturing companies in general, to be
Yeah,
honest. If you are highly dependent on raw materials and labor and you have inflation starting to climb as well as interest rates, uh, those raw material prices are going to start climbing as well.
definitely.
And
And
obviously that could apply a lot of pressure.
uh, that's actually what I wanted to show you. And we've
Mm,
got a good chart here quickly. If I just scroll down, which just shows you something which the company looks at, which is a return on sales. And this is
okay.
really equivalent to, say, you can say like an EBITDA margin. They take earnings before interest, amortization, and adjusting items to basically get you to over sales to get you to a percentage. And you can see it's just declined a bit, and that's partly due to the
Yeah.
sort of rising inflationary cost pressures. This company actually has a fiscal year end of April, so it's slightly delayed. So
Yeah.
the 2021, we still haven't factored in most of it from a calendar year.
So in fact, the 2021 year in that chart is between April 2020 and April 2021. So the bulk of last year, the second
Pandemic.
half of which is when, when inflation really started to ramp up, we haven't actually seen that effect in the financial statements yet.
Yeah, and you can imagine where the world was. That was just massive
Yeah,
frozen sort of things weren't sort of moving that fast, and especially in a company like this, it was just frozen, wasn't it? Retail was just dead.
yeah.
So it probably impacted them somewhat. But yeah, that's sort of just going back to the note there. But yeah, you can go back to our discussion on sort of
Okay. So we've talked a bit about how the revenue's flowing in and out, and we've also talked about cardboard not being a particularly sexy business model. But how has the stock performed over the last 5 years?
the stock has actually, so 5 years it's actually been fairly sort of up and down in terms of the stock price. So it hasn't actually seen it, but over a 10-year period, we've seen it's gone up 3 times in value. But
Oh,
actually, over the last sort of 5 years, it's down, I think, I believe, sort of 18%.
oh, okay.
It's been fairly volatile over the last few years, and it hasn't seen massive increases. Part of that is due to, I think, the initial uptake was e-commerce. So I think it's done very well over the last 10
Mm,
years with the massive
yeah.
e-commerce boom and being able to service e-commerce as a massive customer of theirs. But I think the last few years with the whole ESG, and we can talk about it, and potential things happening in that space, it's become less and less. Maybe the market has favored it less, given what it does, um, and given how people are trying to probably do things in a different way. So I think that's why you've seen not massive changes in the stock price. And it's not a growth stock. And talk about it in revenue terms, actually, in the last few years, it's been very flat. So that might be one of the reasons why you've not seen massive growth in the share price, where revenues haven't really moved where you'd want them to move. Because at the end of the day, it all goes down to fundamentals.
Yeah, I mean, it's not an uncommon story for non-growth stocks. Income stocks don't tend to move as much, but on the other hand, they do. Shareholders do benefit from what usually is a sustainable and recurring dividend, which obviously offsets the relatively flat performance. But like you said, over the last 10 years, as e-commerce became more and more dominant in consumer shopping habits, the company has managed to profit. And even today, e-commerce, it's only around 30% of retail spending. So there's plenty of growth left ahead.
Yeah, exactly, definitely. I
Which,
think
yeah.
promising,
Okay.
for sure.
Yeah. So, may not be the sexiest in terms of growth. We've talked a bit about revenue, but in terms of its financial position today, what does the sort of balance between cash and debt look like?
So on the balance sheet today, they have 744 million pounds of cash, which is quite a large number. But when you take into account everything else, it has sort of 3 billion in plants, property, and equipment. As we said, this is a very physical sort of it's a business which needs massive warehouses to do what they do. So you would expect property, plant, and equipment to be quite high. It needs a lot of
Hmm.
space to do that. And then in addition, it has something called intangible assets, which is around sort of 2 billion. And we'll go into what that has inside of it. But it does have some debt. It does have sort of 2 billion of debt, and operating profits have taken a hit. But we're not too concerned with their ability to pay back their debt. On the one hand, the cash is still the cash flow there can service that debt, and with the cash on the balance sheet and also with potential sales of their PPE, it's not too much of a worry. And I think it's fairly normal for a business of this nature to have the sort of capital structure that it does have. The intangible assets is a bit worrying because majority of that is in goodwill. And goodwill, for those who don't know, is when you pay you pay a premium for a business, and the premium above the assets is put on the balance sheet on the asset side as a sort of something that you would impair every year. So it becomes less and less. It becomes less valuable each year, and it's just there as a sort of plug-in to balance the numbers. But yeah, it's not something you would want to have as a high number on your only balance sheet. And so I'd say it's fairly robust, and sort of typical of a business of this nature.
Okay, so no sudden risk of bankruptcy in the horizon, in your opinion, then?
No, not hopefully. And I think also it has a lot of options it can do to deal with that, right? If it was going through financial difficulty, it can just sell its property, plants, and equipment.
Yeah,
It's not a business like the oil and gas sector where you have these cycles, don't they, where oil prices go up, suddenly you have massive capex, expansionary
yeah,
capex, because they suddenly see, oh great, they've got so much money they can expand, and then oil prices go down, and it's like, oh, we can't sell because it's not profitable for us to be selling at this price, because it's
no.
dictated by the market. Whereas in here, they can control pricing a bit, so they have some level of pricing power, and actually it's easy for them to just sell one of their property, plants, and equipment. It's not too, those assets could be reused for other industries, whereas in oil gas it's quite different.
Obviously, being the group has got around 750 million pounds of cash, as you mentioned earlier. Being completely reliant on wanting to sell a facility to cover debt expenses, obviously not a good plan, and that doesn't seem to be the case with DS Smith. But I think it's definitely worth keeping an eye on. You can. Okay, so property, plant, and equipment, it's not the most liquid asset out there, I suppose, but it does
Yeah,
serve as a form of asset you can dispose of if you need cash in an
yeah,
emergency,
and I think
especially
seven.
when it comes to. Do you want to finish
Yeah,
your
no,
point?
you're right, yeah, and especially when it comes to sort of being in financial difficult situation, and you've seen it time and time again, asset sales
Mm,
that continues to
yeah,
happen. You saw it in the case of Tesco's. You see it in many other different cases where Tesco's was struggling at one point a number of years back with a potential, downgrading of it. I believe it's still, I don't know if it's got high yield. It was between high yield and investment grade ratings, and one of the reasons was because of the huge amounts of debt they had in the business and the free cash flow. So yeah, they do these things where I think at that time the CEO had a plane. It's always a red flag. But yeah, you can see things like where there can be cost cutting measures. So I'm not too worried. And 744 million just on the cash is there to support the debt and the business.
So obviously, to avoid such situations where you're forced into an asset sale, you'd want to have a competent management team running the ship, making
Yeah.
sure they're doing something sensible. So, what are your thoughts on DS Smith's management team?
So DH Smith is a FTSE 100 company, so you'd expect it has a seasoned management team. And although we talked a bit about this business was started 80 years ago and by the Smith family, none of them are sort of involved in management or sort of executive management, as far as I'm aware. But you have in management today, you have an individual called Miles Roberts. So Miles Roberts was previously CEO of McBride, and he's been running this business for the last 12 years. And since then, as I mentioned before, the stock price has tripled. So clearly he's doing something right, and you sort of wonder, and it's a business which is it's a boring business, so you would want some strong, stable hands running the business, and you'd probably want long tenures in a business like this because it's based on sort of long-term relationships and getting things right, and it's the cost of getting something wrong is greater than the cost of getting it right in this sort of industry. And he's tripled in value. His compensation is long term, is aligned with with shareholders. 225% of his he gets shares as a percentage of his salary, so that keeps his long-term incentives there and aligned with the share price. This year he got paid close to $1 million in just basic salary and 1.54 in bonuses, so his incentives are strong, and so he's not going to run away. And with that stock incentive, he's going to be there for the long term and try to continue to transform the business into this sustainable packaging business that they need to become to be relevant. With the ESG as a big criteria in investors' minds and companies' minds, it needs to continue to go to those efforts, which it says it's going to be by next year 100% recyclables business. So 100% of their materials are recyclable. So we'll see if that happens and that's achieved. But yeah, it's moving in the right direction.
If they can reach 100% recyclable material, I think, well, first of all, bravo. That's quite, a good achievement. I suppose it also helps differentiate the firm from its competitors somewhat. Now that we're having more aggressive carbon taxes being placed on companies, and recently, I think the SEC have begun discussing whether or not companies should be disclosing their carbon footprints in their regulatory, like annual reports each year. With more and more pressure being put on companies trying to cut down carbon footprint, buying cardboard for packaging which are made of 100% recyclable materials actually could serve as some form of tax benefits for its customers. And that could turn into a competitive advantage. But what else do you think differentiates this company from its rivals?
Yeah, so I think on the one hand, it has a strong brand in the sense that it's got quality. It's producing these cardboard by nature is you could say it's a commoditized product, but they've got this long-term relationships with key FMCG companies, which they've clearly sort of won. So they've got this strong relationships, which creates barriers to entry because anybody coming in, the cost of replicating this model is pretty huge. It's not like tech where you can sort of be worried about someone in their garage creating something which is so innovative that it can take it can suddenly worry you. But they are, we'll talk about the threats later. But yeah, the key here is that from what they do and the manufacturing packaging space, I think it's fairly sticky money. I think it's hard for anyone to switch. So the switching costs are quite high for anybody to want to switch from them to others. You've also got the fact that the brand is there now. It's quite well known. It's FTSE 100 company, very stable. So if you're a manufacturing or if you're a fast FMCG company, you probably are going to want somebody who's going to be reliable. That you've got all these goods to ship and you haven't got somebody to give it to you. So you'd want someone fairly reliable. And actually, it's a local market leader in Europe. You can see it. We've talked about the numbers and the size and the scale. It's fairly big. You have some competitors in America, which is like the International Paper Company, Westrock Company, etc. But nothing in sort of, you haven't got massive ones in Europe. So that's a strong plus, and it's trying to be innovative with sort of being 100% recyclable. So these are all positives for the company. But yeah, we're yet to see. It's one of those things where it's a company which doesn't have massive threats to it in terms of a lot of competitors attacking them directly, but they might attack them in different ways, and we'll talk about that a bit later. But yeah, it's one of those things where you don't see their revenue growth growing 100% next year, but you don't see their revenue just being destroyed over 1 year.
Yeah.
Because these probably take time for changes to happen in this space and in the area they operate.
So you have the safety of consistency. You have clients, even if there are alternative cardboard suppliers, that undeniably there are. A company who's already spending with DS Smith, unless there was a considerable cost saving somewhere, is unlikely for them to swap over just because they know DS Smith, they know they're reliable, their orders will arrive on time. That's sort of customer client relationships, which they take time to build.
Now, especially when something's so important to your supply chain. And when
Yeah,
you're trying to get things to customers, you don't want to risk that. And
you
you
don't
know, if
want to
you're a
faff
fast move,
about. You,
especially if
yeah,
you're a fast moving consumer goods company, you want a big company to be reliable to make sure you deliver it. It's a bit like how you've got the challenger banks and they're trying to take away, you know, get people to join, but people are still with the traditional banks because of that safety net, aren't they?
yeah, yeah. Okay, so you sort of touched this very briefly. But we should probably go into more detail. What do you think the biggest threats are to this company today? What should shareholders or potential investors be aware of?
I think one of the biggest issues is whilst there's not direct competitors in cardboard that we should be worried about, it's more the other innovative solutions that are out there in terms of packaging. So you're finding that there's different fiber material sort of competitors who can do things differently. So, you know, we've seen businesses where they're packaging in ways which is, again, ESG friendly, but it doesn't require sort of cardboard to be packaging it. There might be other alternatives. And that's where someone like a DS Smith would be concerned if there's other alternatives to package goods, which is cheap, which is important, but biodegradable. So it can be destroyed by itself, and it's rigid that it's strong enough to carry these goods and be there. So there are other alternatives which makes you sort of, and if it's more cost effective and actually takes less space, then you know for a FMCG company or e-commerce, it might become more attractive. And especially if you have better ESG credentials, it might be easier. And if it's biodegradable, the whole issue of end of life doesn't have a huge issue. Although DA Smith would collect it back, it's just less hassle, isn't it? If the end of life is
Yeah,
just biodegrades. So there's that as one of the key sort of weaknesses. And another one is really just the costs. We talked a bit about just input costs, but you know, if we continue to see, as we are seeing now, massive increases in input costs across the board, that will naturally feed into what DS Smith is doing. Labor costs are rising. That's just going to eat margins. And I don't think they have huge amounts of ability to negotiate better pricing with their customers, and that might be an issue. We might see that in the bottom line as an impact. So that's something you could be sort of concerned about.
and obviously, if inflation puts pressure on margins and earnings end up suffering for it, then the dividends could be next.
Yeah, of course.
Which,
No, definitely. And
if
I
you're
think that,
if you're an income investor, that's obviously not a good sign. Uh,
I
we'll
think so.
see
And
at this stage.
yeah, definitely. It's there's a lot of things that you've got to be sort of worried about in terms of um, cost, but that's across the board, isn't it, with all companies and
Yeah.
inflation, and which companies are best able to pass it through customers.
Well, with any luck, DS Smith will be able to do that. We'll be able to see very shortly. Their next set of results are coming out soon, so we'll have to keep tabs on that. But based off the information we have available to us today, valuation-wise, do you think the share price is currently at a sensible level, or is there an opportunity for investors
So yeah,
buy some shares?
we did a discounted cash flow methodology, as we tend to do with the
Mm.
majority of our stocks that we look at the Money Cog. There are occasions where we do look at multiple analysis, or where we think it's more sensible to look at them. So in this case, I took revenue assumptions and assumed that revenues next year would grow to 6 billion, so not ridiculously higher than what they are today, and then just growing from there 6%, and then falling in line with inflation. And what we got to was a price which is actually double what the price is today, which people could
Wow.
find quite shocking. So it's 643 pence, and you know the price today is around sort of 320. So it does suggest that the stock is considerably undervalued. And I think a lot of that is to do with the fact that the market hasn't fully appreciated what this business does from a cash flow generation perspective. And actually, it is going through that 100% recyclable. And actually, it is speaking to other players that are providing other innovative solutions that sort of I'm aware of, having spoken to myself, companies that are in the recyclable industry, and that actually boasts, you know, that's quite strong for the company, because you could sort of say that, well, actually, if it is speaking to the right people within the space of innovation, then you could expect it to be around for another good 20 years. And cardboard boxes and fast moving consumer goods will still always need solutions to provide to move these boxes and move their goods around. So this is a solution that I think is there, and if it can get to 100% recyclable, I don't see why it becomes an issue for anybody. And I think just the market hasn't quite picked up on it, and maybe it's taking the hit because of just the nature of the business, maybe just being overlooked as something on the FTSE 100. And then I think being a FTSE 100 company, maybe it's just one of those things where it's just been overlooked by investors for just reasons where the market has sold off. So it's sold off just like the rest of the market. It's down 18% for the last 5 years. So it's probably the reason why. Actually, I think it's something worth looking at.
Certainly sounds like quite the opportunity if the model came out with the valuation. It's such a vast difference. Another potential explanation, of course, is that investors are aware of the value of this business, but are more concerned with the disruptive advancements in packaging fibers and other sort of materials coming about. And if DS Smith's products ultimately end up becoming obsolete because there are better alternatives out there, then clearly that valuation isn't going to hold up.
No, and I think that's true. But if you apply some margin of safety and you say, well, the upside is so great, but what's the probability of the upside? And you say, okay, if there's a 50% upside, but you're assuming a probability of that happening 50% of the time, that's a 25% increase. And if you expect you expect the price is fairly right, sort of another 50% of the time, then that's like a 0% increase. Still up 25%, aren't you? Still got a 25% upside. So it makes sense. And these are all things. There's all different ways we talk about in sort of the Money Cog about how you look at investments, which is, you've got to take things into different lenses. And something we'll write a bit about, and I'm going to write a bit about more on the Money Cog website, which people can find below, is expectation investing. So, which is all about understanding what markets are expecting or what's being priced in and why that's wrong. And that's where you make your money, right?
Yeah, we've seen a lot of that in recent years, where, especially with tech stocks, in fact, a lot of the valuation, or share price, I should say, is being driven by expectations of future cash flows, which in some instances have been outright absurd, to the point where you have 50% drops in share prices, and a few of them within a day because earnings were missed by a small amount, and it opens the door to a lot of volatility. Fortunately for DS Smith, it doesn't seem to fall under that category. So bringing everything together, DS Smith obviously was assigned a COG score, which can be found in the report. As a reminder, this is a metric we have used and developed to judge and assess the quality of the underlying businesses. The score, the better, and it's looking at both qualitative and quantitative aspects. So putting everything together, what do you think, why did you assign a score as you did for this particular company?
So I think you sort of take into account the qualitative and quantitative metrics. Quantitative side, it's got that sort of cash flow, which is quite attractive. The qualitative is management. It's good. It's in a sector where the competitive advantages are pretty strong in its favor, in terms of, the ones that we've mentioned, that it's got certain amounts of sort of the barriers to entry are quite attractive. So it's received a slightly higher, not a high COG score, but it's a decent COG score. And the threats and that innovation thing that we talked about is something to worry about. Revenue has been fairly flat. Again, is that something to worry about, and how fast can that continue to grow? And can it actually expand into the US market, which is looking to do, which is a bit of concern, given there are other competitors in the US. So sort of combining that sort of reflects where the valuation, where the COG score is, and people can see that COG score on the website.
Yeah, well, thank you for spending the time going through this business in more detail, Imran. As a reminder, a link to the full report can be found in the description of this video. And don't forget to give us a thumbs up if you enjoyed this, and add your comments to the discussion if there's anything you think we should have talked about and we didn't. Thank you very much, Imran. We'll see you next week.
Thank you.